Hi. In this video we will be talking about the 5 biggest mistakes when filing taxes and how to avoid them. Watch this video to the end to delve into the 5 biggest mistakes when filing taxes and provide practical strategies to avoid them. Welcome back to the International CEO. Tax season can be a stressful time for many individuals and businesses alike. Filing taxes accurately and efficiently is crucial to avoid penalties, audits, and unnecessary headaches. However, there are common mistakes that taxpayers make every year that can lead to complications with the Internal Revenue Service, IRS, and potentially cost them money. In this comprehensive guide, we will delve into the 5 biggest mistakes when filing taxes and provide practical strategies to avoid them. Failure to keep accurate records. One of the most common mistakes taxpayers make is failing to keep accurate records throughout the year. Without proper documentation, it's easy to overlook deductions and credits that you're entitled to, leading to overpayment of taxes. Additionally, if you're ever audited by the IRS, having thorough records will be essential in substantiating your claims. To avoid this mistake, it's essential to establish a system for record keeping early in the year. This could involve keeping receipts for deductible expenses, maintaining mileage logs for business-related travel, and organizing financial statements and investment records. Using software or apps designed for expense tracking can streamline this process and make it easier to stay organized. Furthermore, consider consulting with a tax professional who can provide guidance on the types of records you should be keeping and how to maintain them effectively. By staying proactive and diligent with your record keeping, you'll be better prepared come tax time and reduce the risk of errors on your return. Misreporting income. Misreporting income is a serious mistake that can result in penalties and interest charges from the IRS. Whether intentional or accidental, failing to report all sources of income on your tax return is a surefire way to attract unwanted attention from tax authorities. Income can come from various sources, including wages, salaries, tips, self-employment earnings, interest, dividends, rental income, and capital gains. It's crucial to accurately report all income earned throughout the year, regardless of whether you receive a Form W-2, 1099, or other documentation from the payer. To avoid misreporting income, carefully review all forms and documents you receive from employers, financial institutions, and other sources. Keep track of any additional income you earn through side gigs, freelance work, or investments. If you're unsure about how to report a particular type of income, seek guidance from a tax professional to ensure compliance with IRS regulations. Additionally, be aware of common sources of unreported income, such as cash payments, bartering arrangements, and virtual currency transactions. The IRS has increasingly focused on enforcing compliance in these areas, so it's essential to be transparent and accurate in reporting all sources of income. Overlooking deductions and credits. Deductions and credits are valuable tools for reducing your tax liability, but many taxpayers overlook them or fail to claim them correctly. Deductions allow you to subtract certain expenses from your taxable income, while credits provide a dollar-for-dollar reduction in the amount of tax you owe. Common deductions include those for mortgage interest, property taxes, charitable contributions, medical expenses, and unreimbursed business expenses. Meanwhile, credits such as the Earned Income Tax Credit, EITC, Child Tax Credit, and education credits can significantly lower your tax bill if you're eligible. To avoid overlooking deductions and credits, familiarize yourself with the tax breaks available to you based on your personal situation. Keep detailed records of qualifying expenses and be sure to claim all deductions and credits for which you qualify. Consider using tax preparation software or consulting with a tax professional to maximize your tax savings and ensure accuracy on your return. It's also essential to stay informed about changes to tax laws and regulations that may affect the availability of certain deductions and credits. Tax laws are subject to frequent updates, so what was deductible last year may not be deductible this year. By staying proactive and staying abreast of changes, you can take full advantage of available tax benefits. Filing incorrectly. Filing your taxes incorrectly can lead to delays in processing your return, triggering audits, and potentially incurring penalties from the IRS. Common filing errors include entering incorrect personal information, mathematical mistakes, and using the wrong filing status. To avoid filing incorrectly, take your time to review your tax return thoroughly before submitting it to the IRS. Double-check all personal information, including your name, social security number, and address, to ensure accuracy. Use tax preparation software or enlist the help of a tax professional to minimize mathematical errors and ensure that all calculations are correct. Choosing the correct filing status is also crucial, as it can affect your tax rate, eligibility for certain deductions and credits, and other aspects of your tax return. The 5 filing statuses recognized by the IRS are single, married filing jointly, married filing separately, head of household, and qualifying widow, with dependent child. Selecting the wrong filing status can result in incorrect tax calculations and potential discrepancies with the IRS. If you're unsure about which filing status to choose or how to complete your tax return accurately, seek guidance from a tax professional. They can provide personalized advice based on your individual circumstances and help you navigate the complexities of the tax code. Missing deadlines. Missing tax deadlines can have serious consequences, including late filing penalties, interest charges on unpaid taxes, and missed opportunities to claim refunds. The IRS imposes strict deadlines for filing tax returns and paying any taxes owed, and failing to meet these deadlines can result in financial repercussions. The deadline for filing federal income tax returns for most individuals is April 15th, although it may be extended to the next business day if April 15th falls on a weekend or holiday. If you're unable to file your return by the deadline, you can request an extension using IRS Form 4868, which will give you an additional 6 months to file. However, it's essential to note that an extension to file does not extend the deadline for paying any taxes owed. You must estimate your tax liability and pay any amount due by the original filing deadline to avoid penalties and interest charges. In addition to the deadline for filing your tax return, be aware of other important dates throughout the year, such as the due dates for estimated tax payments and deadlines for contributing to retirement accounts and health savings accounts, HSAs. Missing these deadlines can result in missed opportunities for tax savings and potential penalties for non-compliance. To avoid missing deadlines, mark important dates on your calendar and set reminders well in advance. Consider using tax planning software or enlisting the help of a tax professional to stay organized and ensure that you meet all deadlines. By staying proactive and keeping track of key dates, you can avoid unnecessary stress and financial consequences associated with missed deadlines. Failure to keep accurate records. Keeping accurate records is fundamental to proper tax preparation. However, many individuals and businesses struggle with this aspect, leading to missed deductions, errors, and potential audits. To avoid this mistake, let's explore some best practices for record keeping. Establish a system. Start by setting up a reliable system for organizing your financial records. This could be as simple as using folders or envelopes for different types of expenses, or you could leverage accounting software for digital record keeping. Document expenses. Keep detailed records of all deductible expenses throughout the year. This includes receipts, invoices, and other documentation related to business expenses, charitable contributions, medical costs, and other eligible deductions. This documentation is essential for claiming deductions related to vehicle expenses. Reconcile regularly. Schedule regular times to reconcile your financial records, ensuring that all transactions are accurately recorded and categorized. This will help identify any discrepancies or missing information before tax time rolls around. Stay organized. Develop a habit of staying organized throughout the year, rather than waiting until tax season to sort through piles of paperwork. By staying on top of your records consistently, you'll save time and reduce stress when it's time to file your taxes. By implementing these strategies, you can streamline the record-keeping process and ensure that you have the documentation necessary to support your tax return. Misreporting income. Misreporting income is a serious offense that can result in penalties, interest charges, and potential legal consequences. To avoid this mistake, it's crucial to understand the different types of income and how to report them accurately. Understand taxable income. Familiarize yourself with the various types of income that are subject to taxation, including wages, salaries, tips, self-employment income, interest, dividends, rental income, and capital gains. Make sure you report all sources of income on your tax return, even if you didn't receive a Form W-2 or 1099. Review documentation. Carefully review all tax documents you receive from employers, financial institutions, and other payers to ensure accuracy. Compare the information on these forms to your own records and report any discrepancies to the issuer promptly. Report cash income. If you receive cash payments for goods or services rendered, it's essential to report this income on your tax return accurately. Keep detailed records of cash transactions to substantiate your income in case of an audit. Report virtual currency transactions. The IRS requires taxpayers to report virtual currency transactions, such as those involving Bitcoin or Ethereum, on their tax returns. Be sure to include any gains or losses from virtual currency transactions when calculating your taxable income. Consult a tax professional. If you're unsure about how to report a particular type of income or have questions about your tax obligations, don't hesitate to consult with a tax professional. They can provide guidance based on your individual circumstances and help you navigate complex tax issues. By taking the time to understand your tax obligations and report income accurately, you can avoid costly mistakes and ensure compliance with IRS regulations. Overlooking deductions and credits. Deductions and credits can significantly reduce your tax liability, but many taxpayers overlook them or fail to claim them correctly. Know your deductions. Familiarize yourself with common deductions available to taxpayers, such as those for mortgage interest, property taxes, state and local taxes, charitable contributions, medical expenses, and unreimbursed business expenses. Keep detailed records of eligible expenses throughout the year to ensure you can claim them on your tax return. Explore tax credits. Tax credits provide a dollar-for-dollar reduction in the amount of tax you owe, making them particularly valuable. Research available tax credits, such as the Earned Income Tax Credit, EITC, Child Tax Credit, Education Credits, and Retirement Savings Contributions Credit, to see if you qualify. By following these guidelines and taking the necessary precautions, you can avoid common filing errors and ensure that your tax return is accurate and compliant with IRS regulations. Missing deadlines. Missing tax deadlines can have serious consequences, including penalties, interest charges, and missed opportunities for tax savings. To avoid this mistake, it's essential to stay organized and aware of key tax deadlines throughout the year. Know the filing deadline. The deadline for filing federal income tax returns for most individuals is April 15th, although it may be extended to the next business day if April 15th falls on a weekend or holiday. If you're unable to file your return by the deadline, you can request an extension using IRS Form 4868, which will give you an additional 6 months to file. Pay taxes owed on time. If you owe taxes to the IRS, it's crucial to pay them by the filing deadline to avoid penalties and interest charges. Even if you're unable to pay the full amount owed, paying as much as you can by the deadline will help minimize penalties and interest. Make estimated tax payments. If you're self-employed or receive income that isn't subject to withholding, such as investment income or rental income, you may be required to make estimated tax payments throughout the year. Be sure to make these payments on time to avoid penalties for underpayment of taxes. Contribute to retirement accounts. Take advantage of tax-advantaged retirement accounts, such as IRAs and 401ks, by making contributions before the annual deadline. Contributions to traditional IRAs and 401ks are typically deductible, reducing your taxable income for the year. Consider tax planning opportunities. Throughout the year, be proactive about tax planning to minimize your tax liability and take advantage of available tax-saving opportunities. This may include strategies such as charitable giving, maximizing deductions and credits, and managing investment gains and losses strategically. By staying organized, proactive, and aware of key tax deadlines, you can avoid the stress and financial consequences associated with missing deadlines. Filing taxes can be a complex and daunting process, but by avoiding the 5 biggest mistakes outlined in this guide and following best practices for tax preparation, you can streamline the process and minimize the risk of errors, penalties, and audits. Keep accurate records, report all income correctly, claim all deductions and credits for which you qualify, file your taxes accurately, and meet all deadlines to stay in compliance with IRS regulations. If you're unsure about how to navigate the complexities of the tax code or need assistance with your tax return, don't hesitate to seek guidance from a tax professional. They can provide personalized advice based on your individual circumstances and help you make informed decisions to optimize your tax situation. By taking control of your finances and staying proactive about tax planning, you can make tax season a less stressful experience and keep more money in your pocket. Remember that the key to successful tax filing is preparation, attention to detail, and adherence to IRS guidelines. With careful planning and diligence, you can file your taxes with confidence and peace of mind. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.